Welcome to yet another video from Learning Simplified. We're talking about reporting and managing inventory today, which is based on Chapter 12 of the Cambridge VCE Accounting book, the third edition, and relevant to Unit 2 from the VCE Accounting. Alright, so with respect to reporting for trading firms, what sort of reports do we have to prepare? Usually, so far, we've seen the three main reports being prepared, which are the three general purpose financial reports relevant to inventory as well. We've got one, the cash flow statement, two, income statement, third, the balance sheet. So, with income statement and the balance sheet, we are reporting the inventory items. Cost of sales is an expense. On the one hand, it results in a decrease in assets. On the other hand, it results in the decrease in the owner's equity. So when we look at the accounting equation, A is equal to L plus E, we're having this impact on both of the sides, balancing it out. But remember, it's one of those expenses that isn't really resulting in a cash outflow. Hence why it's not impacting our cash flow statement. And the calculation of it involves adding all the sales in the out section in the inventory card and subtracting all of the sales returns that are in the in section of the inventory card. With the cash flow statement, the movement of inventory is going to be recorded in the operating cash flow in the ordinary course of business. Any cash purchases are going to be in the outflow, and the cash sales are going to be in the inflow part. That's how it's impacting the cash flow statement. In the income statement, we're going to show two separate figures for profit, gross profit and net profit. And the differences in the income statement for a trading firm that are going to be with respect to how the revenue and expenses items are broken down and presented are going to be as follows. One, your net sales figure, that is going to be your total sales less sales return. Second difference is the cost of goods sold figure. That's the expense related to getting all the inventory onto the shelf and ready for sale. It includes cost of sales as well as freight, any cartage, any delivery inwards that you've paid, any import duties, any custom duties, any modifications you've had to make, any packaging, other buying expenses. But any cost, remember, any cost after selling the inventory is considered other expense. So it's going to be in the different category of the income statement, like delivery to customers. Then you have the gross profit. So far we've looked at this net sales figure, cost of goods sold figure. We've got the gross profit now. That gross profit is net sales less cost of goods sold. Okay. Looking at it from here, same thing, net sales less cost of goods sold. Then you have the adjusted gross profit, which is gross profit minus inventory loss or plus inventory gain if you have one. And then last but not the least, we have our net profit, which is this adjusted gross profit less other expenses that are here. Okay. And that's what gives us our net profit. We look at financial indicators as a way of figuring out whether the business is doing good or poorly and what needs to be improved. Okay, so not just as a diagnostic measure, but also something that helps us take the corrective action. So with a net profit margin, the formula is net profit divided by net sales into 100. Remember, it's a net profit and a net sales. With a gross profit margin, it's gross profit, not net, divided by same net sales into 100. So while the denominator is the same, numerator is very, very different and will give you very different answers for both of these. How do we assess gross profit margin? So usually the size of the gross profit margin is going to indicate how big of a gap do you have between selling price and cost price, which will indicate the size of the average markup. So let's say I've got an item that I was selling at $20 initially. Now I've increased the price to $30. So per item, on average, I've increased $10. That'll go towards my markup increase. But what's happened as a result is, let's say if at $20 selling price, I sold 100 quantity of this particular inventory item. Now at 30, perhaps people are not able, some of the people are not able to afford this particular item from us. So we'll probably sell only at this particular price, only about 50 quantity. What's happened is, yes, while per item I've increased my average markup, which is going to be higher gross profit per item and higher gross profit margin when I calculate using the indicator formula. But my gross profit in dollars is falling. Even if you look at the overall, you are at a risk of overall lowering the demand. Thus, you're reducing the volume of the sales. So if sales volume starts dropping too far, your gross profit in dollar is going to be falling. Alternatively, your purchase price can be reduced, and as a result, that can result in cost of goods sold being decreased. So what's going to happen is, you can say, all right, I'm not going to change my selling price, but I want to still see changes in my gross profit margin. And what else can I do to ensure that happens? You can perhaps purchase from a supplier that supplies goods at a cheaper cost. So, a lower cost price. But do I really want to compromise on the quality of the products that I sell? Maybe not, because again, we do not want that scenario of losing customers or decreasing volume of sales or a high sales return, because a lot of faults keep coming up with that particular quality. So the other thing that we can do to ensure we're getting discounts on our purchase price is, you can perhaps purchase in bulk. So if you purchase 10 items from a supplier normally, and you know you're still going to place orders without obviously incurring extra warehouse expenses for storing these items, if you are able to in one go get more than, let's say, if the supplier says you buy 50 from me, I'll give you a better discount. So if without incurring those other costs of, perhaps you don't have any risk of theft or damage, you have already an existing paid warehouse where you have space ready to go, then yeah, it's a good alternative. Buy in bulk so you get a lower cost per item. Okay. And that is especially important for goods that are not going to be something like a perishable item like milk, that are at the risk of spoiling. What about the balance sheet? In the balance sheet, inventory is reported as a current asset, and relevance is what dictates that a single figure be reported in balance sheet. Okay, so what we're going to do is, we're going to determine using an inventory sheet based on physical count, and we'll make the adjustments for the loss of the gain. That's one way. Alternatively, how do we find out that single figure? We can use a formula combining data from the journals, inventory cards, and other information. So you've got the first example on this side here, where you've got the different kind of items. So you've got different tires, okay, and a total inventory on hand 31st of August 2025, which is this figure right here. Then we've got the example of looking at where all can we get the information from. So you've got the balance at the start from the previous balance sheet. So this will usually be given to you, plus the cash purchases, plus the credit purchases, and minus any purchase returns. Okay. Again, it tells you exactly where you're going to get this information from. Then we have less the cost of goods sold from the inventory cards, balance as per inventory card, and if you did the stock count, you would also have in the inventory card entry loss or a gain. And then that should be our balance as per physical count, because that's how we've got this. And this is important, that goes into the next balance sheet. So it gets carried forward. Inventory turnover, what is that used for? So you will most likely get a lot of questions in the exams and the SACs regarding this. It's an efficiency indicator. So it's really measuring the average number of days it's taken to sell the inventory. And depends on the kind of item it is. But sometimes, like milk, you would much rather have a very less number of days in inventory turnover, which will indicate, yes, we're able to sell milk at a decent rate, so it's not getting expired. Okay? So faster inventory turnover equal to low days means on average inventory sold quickly, and we're able to generate cash from selling this inventory, and we're able to assist our liquidity. If the stock is sitting there for days on an end, like you've got milk sitting there purchased from 10 days ago, probably not a very good thing, especially if it's not the long life milk. Okay. Average inventory is measured in dollars. Please keep that in mind. The formula is inventory at start, so at the beginning, plus at the end, divided by 2. And inventory turnover itself is measured in days. The formula is given on the screen. Average inventory divided by cost of goods sold into 365. Now you'll probably get some questions after you've calculated the inventory turnover, whether it's good or bad, whether it's improved or worsened since the last year, let's say. The acceptable rate, there is no such sort of one black and white answer. It really depends on the nature of inventory. So perishable items, like I said before, should be turned over quickly. As well as the products that are at the risk of obsolescence, like you've got your iPhones, okay, technology or fashion, like you don't want a fashion line from the Paris Fashion Week from 2020 still sitting in 2024. So usually, what sort of things can we measure it against? A benchmark such as what are the past figures for inventory turnover, so history that shows an established trend. Then a budgeted inventory turnover. What did we think is going to happen? So what are the predicted figures or targets? Next, the inventory turnover of similar businesses or industry averages. Next, we think about how do we manage that inventory turnover? So if we've identified that our inventory is moving really slow and we would like to get rid of the stock on hand a lot faster, what can we do? We can either increase the level of sales, which will involve increasing the cost of sales, reducing the days taken to sell inventory by improving our inventory mix. So if we sell just the one item and it's not popular, maybe change it up a little. Increase advertising. So if we don't use social media advertising at the moment, perhaps it's a good idea to start using that, or discounting any slow lines of inventory. So something not being sold and it's nearing expiry, let's start discounting it. Second, you decrease how much of inventory you keep at all times. So inventory holdings. Either purchase less from the very start. Okay, so only when you need more clothes, let's say, then go and buy it rather than stocking up your cupboard with unnecessary shopping sprees. And that, in the case of a business, will be known as a just-in-time ordering system. That when we are lowering our benchmark for no, it can't go, a threshold for it can't go any lower than this for the inventory on hand, then that triggers a purchase. So if at any point of time the business has got less than 4 bottles of milk, immediate ordering and that will result in the supplier to deliver a few more the next day. Okay, or you could discount slow selling inventory items, again leading to a faster inventory turnover for those particular slow selling items. But what if inventory turnover is too fast? So costs such as delivery may be higher, and business could lose possibility of earning discounts for bulk buying. Okay, you're ordering too much, and it's like inventory turnover really quickly. You're getting rid of the stock, so you're ordering again and again. So that's why the costs of delivery are higher, and you're possibly buying too less at one time. Hence, why your goods are getting sold really quickly, resulting in you buying again and again. So maybe you're not buying in bulk, and potential profit could be lost as selling price could be perhaps too low. That's why you're getting rid of it so quickly. That all of that inventory is getting sold so quickly. Thus, you must achieve a balance in order to have enough inventory on hand to meet your demand for the customers, and not order so much so as to increase your storage costs and as a result in the future inventory losses. What strategies can be employed by the business owner to ensure wise management of inventory and maximizing the potential for sales? One, set your minimum and maximum inventory levels. So that's a threshold at which you're going to order more or start selling more because you've got too much stocked up. Two, we rotate our inventory. So there's a little bit of mix up. Three, we ensure inventory is up to date, nothing expired, nothing damaged lying around. Fourth, you maintain an appropriate inventory mix. So you have a few different items on hand and not just the one item that is perhaps not being sold. Fifth, you promote sales of complementary goods. So let's say if somebody is buying washing detergent, they will also perhaps see a laundry bag lying next to the cash counter so that you can, the checkout counter. So they can perhaps buy that if they need. And last but not the least, effective marketing. So whether it's social media, flyers, the old way of promoting with the billboards, whatever it is, whatever works well for the business and its target audience. And this is specifically relevant to the SAC preparation for chapters 11 and 12, which is to do with recording inventory and managing it, and of course, analyzing how well the business is able to manage and sell its inventory. So, with respect to the task words, I would recommend paying attention to whether it's a define or a describe or an explain, as well as the marks assigned to the question. So there are a few different task words that we use at a VCE level. Pay very close attention to what kind of task word it is, which will dictate how much you write, as well as the marks that are assigned to that question will help you decide that. Usually, I would avoid any short forms in the SAC when you're writing the answers. So write full sentences and definitely no bullet points. So answer in full sentences and avoid using acronyms. Don't repeat the question unless it's necessary to give context, like in an overall conclusion. So you won't be repeating yourselves and you won't be losing out on precious time. Always answer ethical considerations questions using an answering technique like fields that we've looked at in the class. So financial, ethical, economic, environmental, legal, social, all of that. Then remember to always understand the relevant qualitative characteristics and the assumptions for that topic assessed. Remember, this is going back to Unit 1 when we looked at all the different QCs and assumptions, and whether it's, relevance, whether it's faithful representation, verifiability, whatever it is. Remember to understand that what is applicable in this scenario. Last but not the least, you've got to be ready to analyze the impact of a transaction related to inventory on the accounting equation. Okay, and I've given you a few dot points in the earlier videos what kinds of things you'd have to perhaps analyze, like a cash purchase or a cash sale. And always, always, always show all three elements and then their impacts. So asset, liability, equity, and the overall impact as well as the breakdown. So with the last point here, we've got paying attention to measurements in the final answer. For example, if you're answering inventory turnover versus average inventory versus something else, gross profit margin, let's say, as a financial indicator, then are we answering in days or dollars or percentages or ratio? What is it? Okay. And that brings us to the end. So all the very best. Hit like, share, and subscribe for more such content. We will be coming up with more videos as and when we progress through the topics of Unit 2. All the very best.